Have you ever heard anybody blame the Federal Reserve for all the problems, saying, hey, they kept interest rates too low for too long, causing the inflation, and absent the intervention, rates would be much higher? I have been very guilty of saying this myself as well, but today we're going to take a look at a little bit of a contrarian view by taking a look back at history for a much longer period of time, 700 years. We can see that interest rates have actually been falling for 700 years. This gives some evidence that interest rates may not be artificially low right now, or at least considering the long-term trend of history, may be approaching zero at some point in the future and stay there permanently. Ready? Let's dive in. With interest rates going up recently, just over the last couple of months, they've been getting up to levels like, 3% for a 30-year U.S. Treasury and 6% for a mortgage. That's still extremely low considering just 40 years ago in the 80s, rates were much higher, 10%, 15%, 20% for mortgages. Absolutely crazy considering what they're at right now. Many investors are, number one, upset at policymakers who have forced interest rates so low because that means they're not getting the yield they need. How are you expected to live off of the passive income from a decently sized portfolio if it's spitting off 1%, 2% every year? Partly, by the way, this is why I designed my portfolio allocation course to teach people how to invest regardless of the market so that you know that your portfolio is going to be there for you, not susceptible to deflation, inflation, things like that. And it's 10% off through Labor Day, actually. Link is in the description below. But if we take a look back at the longer term history here, as this chart shows, interest rates have been on the decline for a long time, which means that the recently low interest rates may not be all manipulation. Certainly some manipulation, but not all. And maybe in a completely free market, they wouldn't be nearly as high as we might expect them to be. Now, let's dive into this chart a little bit and we can see that obviously there's a big range here. Every single one of these dots are the actual data points. This line is going to show the trend, and then the moving line here is the 10-period moving average. And so there's some volatility. There is a wide range of interest rates here, but for the last 700 years, it really has trended downwards with some volatile spikes along the way. So what in the world could be going on here? Well, there are many theories as to why this has happened, why this over the last 700 years rates have been falling like this. My opinion is that it's due to the slow amount of deflation that the world has experienced for all of human history. When you look at deflation, what you're really seeing is the money supply is constant or fairly constant compared to the growth of stuff, the growth of wealth, the growth of goods. So when we see throughout history, the last 700 years, the amount of wealth has grown a lot. It's not a zero-sum game like many people think. There's not a fixed amount of wealth. When you go down and chop down a bunch of trees and then you build a bunch of houses and those trees grow back, your economy is much better off. There's more usable goods than there were before. There's the same number of trees and now there's a lot of houses that weren't there before. Now that there's those houses there, you don't have to spend as much time building tents or repairing your tents or moving. You've got resources that can be used to then you can spend your time and your labor and your capital and your other resources to do other things that are more productive. This has happened throughout all of human history. As we offload human labor to machines, we are able to then use that labor to create a lot more stuff than what we could create before, and then use whatever was left over that we were wasting before. We can use that for more productive purposes and use that for other things to create even more wealth. So for thousands of years, for all of recorded human history, that's what we've been doing. That means the amount of stuff has been growing, but for most of history, the amount of money did not grow at the exact same pace. This meant that if it took you all the money to get all the stuff before, now in the future when there's more stuff, it still takes you all the money to get all the stuff, which means that the stuff costs less because you have more stuff, but the same amount of money. And that's what's happened. And you can see that would happen very clearly with an example of the houses, because if there's just one house, well, everybody wants that one house. And so whoever has the most money will be able to buy that house with the most money. So it'll cost a lot. But if there's 100 houses and there's only 20 people, well, then those houses are going to be very cheap because it's easy to get a house. Nobody needs that many houses. And so people are going to buy and sell them from each other at much lower prices. And then everybody gets a bunch of houses. And so you can see that when abundance comes into play, when something was scarce and it moves to being abundant, the cost of it will go down because there's more of it relative to all the money, relative to all the other stuff. And so when all the stuff grows compared to the amount of money, then stuff will get cheaper. This is the natural deflation that has happened for all of human history. As this happens, prices drop, which means that life gets cheaper and people get wealthier. There's less need to get into debt. There's less need to borrow, so the demand for borrowing goes down. This means that anybody who wants to lend will have to lend at a lower price to attract those borrowers. Especially considering a saver will experience a real return on their money by just saving as every year prices go down. That means you would not have a financial incentive to borrow because as prices go down, it makes more financial sense to save first and buy it later. You'll be better off doing it that way versus today when we have inflation. It makes more financial sense many times to buy it today and then pay back with dollars that are worth less later on. And so throughout history, as we've experienced deflation, there's more saving as prices go down. There's more capital accumulation, more saving, less demand for borrowing. So interest rates move down over the course of history. The situation we have today is a little bit different. Zooming in here towards the end, we see a couple massive spikes here in the 40s and here in the 70s that were way off trend compared to where we were before. In fact, we have to go back to the 1700s before we get to interest rates that were at the same place. This is because of the massive inflation that was imposed on the system by policymakers. And then suddenly when prices start to skyrocket again, you have an undoing of all the natural deflation that has taken before. And so interest rates are going to have to go up to compensate. If stuff starts getting more expensive in the future because there's more money, lenders have to demand more to make sure that they're not getting less back in terms of purchasing power than what they lent. But as you can see, this period of time, the last 50 years is a small blip in history compared to the last 700. And all fiat currencies eventually go to zero. And every fiat currency that's still in existence today has already lost at least 95% of its purchasing power since inception. And over the course of history, every time the main fiat currency fails, if a fiat currency exists at all, the people will always resort to using the hardest money again soon. And so if this world does indeed follow the course of the last couple thousand years and this era of fiat currency ends, that means people will eventually start using sound money again. You may think that's gold, silver, Bitcoin, not really pertinent to this conversation. All that matters is that historically speaking, when fiat currencies fail, people start using sound money again. And when people start using sound money again, that means we start to have natural deflation again. And if this trend is showing us anything about the past in interest rates, it means interest rates will probably continue to decline into the future, again, as long as we start using sound money like we have throughout this whole time throughout human history. Now, Seyfried Ammous, in his recent book, The Fiat Standard, great book if you haven't read it, by the way, he recently popularized the idea of interest rates just settling at 0% and probably not moving from there for the future. This is because if you have sound money, prices go down over time, which means that just holding your money in savings gives you a real return. But the problem with sound money is that there is a cost to storage, meaning that if you can lend, then just by lending, you have an even better return than saving without any interest rate, simply because you get rid of the cost of securing it for storage. So subtracting the cost of storage and holding it securely and adding in the additional return that you get from deflation, you don't need a nominal return on your lending. You don't need there to be an interest rate there to get a positive return. And if you do try and charge an interest rate, you probably won't have anybody borrowing from you because it makes more financial sense then to just save instead of borrow. At the end of the day, we can never know what the future holds. We can only look at history and say, hey, things have been going in one direction for 700 years. It's possible things continue to head into that direction in the future. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.